The U.S. labor market, long considered a pillar of economic stability, has just delivered a surprising shock. In November 2025, private employers unexpectedly cut 32,000 jobs, defying analysts' expectations of modest growth. Small businesses, the backbone of American employment, were hit hardest, while larger corporations saw minor gains. This development is more than just a number. It may signal growing economic fragility, shifts in consumer behavior, and potential implications for both investors and households. In this video, Finance Tales breaks down what these numbers mean, why they matter, and how you can navigate the changing landscape of the U.S. economy. Part 1. What happened? 1. The numbers. 32,000 private sector jobs lost in November 2025, compared to a forecasted gain of 10,000 jobs. Small businesses, fewer than 50 employees, bore the brunt, shedding around 120,000 jobs, while larger firms added a small number of positions. Industry breakdown highlights declines in professional and business services, information technology, manufacturing, construction, and financial activities. Wage growth slowed. Year-over-year pay growth for continuing employees cooled to 4.4%, down from prior months. This isn't just a small blip. It's the first sign that the labor market's resilience may be fading. 2. Historical context. Historically, small business layoffs are an early warning sign of economic slowdown. Similar patterns occurred prior to the 2008 financial crisis and during the dot-com bubble burst, when early contractions signaled broader market stress. The U.S. economy has been touted as resilient post-COVID, but unexpected job cuts may indicate that growth is slowing faster than reported GDP numbers suggest. 3. Analyst reactions. Economists note that small firms are more sensitive to consumer demand and credit costs. The unexpected layoffs may influence Federal Reserve policy if the trend continues. Investment firms like Goldman Sachs and Morgan Stanley are watching closely, noting the potential for lower consumer spending and reduced corporate revenue growth. Consumer spending and confidence. Small businesses employ millions of Americans. When layoffs occur, household spending may decline, particularly in discretionary sectors such as retail, dining, and entertainment. Declining consumer confidence can amplify economic slowdown, as spending drives roughly 70% of U.S. GDP. 2. Inflation and interest rates. Job losses could slow wage-driven inflation, potentially giving the Federal Reserve more flexibility in future interest rate decisions. However, if layoffs continue and demand falls too sharply, it may push the economy towards sluggish growth or recession, creating uncertainty for markets. 3. Investment implications. Sectors heavily dependent on consumer spending may see increased risk. Stocks of small-cap firms or companies with high leverage could be vulnerable. Conversely, defensive sectors like utilities, consumer staples, and healthcare may attract investors seeking stability. Part 3. The underlying factors. 1. Rising costs and supply chain pressures. Small businesses face higher energy costs, labor costs, and supply chain disruptions, squeezing profit margins. Many firms have invested in technology and AI infrastructure, but ROI may take longer than anticipated, adding financial pressure. 2. Sectoral shifts. Professional and business services, IT, and manufacturing saw the largest job declines. Companies in these sectors are often early adopters of automation, reducing their reliance on human labor, a trend that may continue. Federal Reserve actions, interest rates, and fiscal policy influence both small and large employers. Analysts warn that rate cuts, fiscal stimulus, or other interventions may be required if layoffs expand, but timing is uncertain. Scenario 1. Short-term slowdown. Job cuts continue, but remain limited to small firms. Consumer spending dips slightly, creating modest pressure on GDP. The Fed may keep rates steady or consider minor cuts. Scenario 2. Broader economic risk. Layoffs expand to mid-size and large firms. Consumer confidence drops sharply, affecting retail, travel, and services. Equity markets may see corrections, particularly in growth and tech sectors. Scenario 3. Strategic opportunities. Defensive investments. Healthcare, consumer staples, and utilities. Long-term growth. Companies adopting AI and automation to improve productivity. Diversification. balancing stocks with bonds, ETFs, or alternative assets. Part 5. Conclusion and takeaways. November 2025's job cuts are a wake-up call for investors, workers, and policymakers. Small business layoffs may indicate early signs of economic fragility. Investors should monitor consumer spending, wage growth, Fed decisions, and sectoral trends. Smart strategies focus on long-term resilience, diversification, and identifying sectors poised for growth despite short-term challenges. The U.S. economy is resilient but not invincible. By understanding labor market trends and their ripple effects, investors can navigate volatility, protect their assets, and position themselves for opportunity in a changing economic landscape.